We're going to discuss market psychology a bit here. So, while there are many trading methods available on the internet, as well as in books and in trading courses, some methods may work well while others may only work intermittently and depend on other market conditions. Advanced traders, for example, may use Elliott wave counts as well as Fibonacci retracement levels to establish the next wave or trend. Many traders use various technical escalators such as the stochastic and MACD indicators, including support and resistance levels, as well as trend lines to establish whether a share is overbought or oversold, and then try to anticipate the share's price next move up or down. For most traders, the task of outperforming the stock market is not difficult. It is the job of beating ourselves that proves to be the challenge. By beating ourselves, we mean mastering our emotions and attempting to think as well as not being influenced by those around us. Trading success based on an emotional response to market conditions is due to chance, and chance does not help us attain consistent results. Objectivity is not easy to achieve because all humans are subject to the emotions of fear, greed, pride of opinion, and all other excitable states that prevent rational judgment. All the information and market knowledge available in the world will be useless without the ability to put that knowledge into action by mastering our emotions. Many novice traders naively believe that with minimal experience, knowledge, effort, and time, they can make a quick killing. They believe that if they use a simple trading method such as a moving average crossover, they'll be successful. This is an unrealistic expectation. Trading is not that easy, and it does require much more thought and attention. Like any successful business enterprise, experience is slowly and steadily built up through hard work and careful planning. There is no rapid road to riches. Beyond the price pattern, changes in price occur to buying and selling pressure. As buying pressure, i.e. demand, exceeds selling pressure, i.e. supply, the price moves up. And as selling pressure, i.e. supply, exceeds buying pressure, i.e. demand, the price moves down. As a trader, you strive to see what the price pattern is headed, where the price pattern is headed, and place your trade accordingly. If you were to determine that a certain pattern is in a downtrend, you would naturally perceive a probability that the pattern would continue downward, unless you determine that the downtrend is coming to an end. And similarly, if you determine that a price pattern is in an uptrend or trading range, you expect that the pattern will continue that way until you see some signal that indicates otherwise. It would therefore be beneficial for you to be able to determine the underlying trend of a given price pattern. At this point in analysis, many traders are confounded by issues of mixed or improper perspectives and the involvement of emotion. For instance, looking at a price pattern for the last hour may indicate a clear uptrend, but looking at the last 8 hours may indicate that the last hour's movement was an insignificant correction and that the true trend of the price pattern is in a downtrend. The key in determining the underlying trend of any price pattern is to look beyond the pattern. Every price pattern forms because of change, and change is the result of buying and selling pressure. The pressure is the result of the decisions investors, primarily institutional investors, and traders make in terms of what they anticipate. Ultimately, a given price pattern is the result of the actions of investors and traders. These actions are based on analysis and opinions of how the price pattern will form. And here, of course, there is somewhat of a cycle because investors and traders are forming opinions about what other investors and traders think and will do. Price patterns are a reflection of a market sentiment. They partly reflect what investors and traders actually think will happen and what they think other investors and traders think will happen. In this regard, price patterns are driven by cyclical motivators, and the more extreme the different opinions are at varying times, the more volatile the price is. As you analyze price charts in preparation for your trades, it is very important that you keep in mind what exactly the charts represent. You're an excellent trader. You maintain your focus, execute winning trades quickly and effectively. You are so involved in and dedicated to what you do, and that you find yourself taking the same kind of mental approach and using the same decision-making skills in situations that have nothing to do with your trading. Over a period of time, your continued success causes you to energetically seek further and greater success, but you stay within the boundaries of your risk capacity and excellent discipline and emotional control. However, without you being aware of it, your psychology slowly begins to transform. Moving on to finding flow. In trading and sports, it is known as being in the zone. A famous psychologist calls peak experiences flow. People experience flow when they spend time in enjoyable activities they find enjoyable for their own sake. During a flow experience, one performs above and beyond expectations. Flow is a Zen feeling. It is similar to meditation or intense concentration. It is an egoless state with all your actions becoming automatic. You may see that if one trades in a state of flow, he or she will attain a high level of trading performance. A famous scientific study conducted many samples of people who engaged in a wide variety of activities. The goal of the study was to describe the components of flow experiences and determine how individuals could pull themselves into a state of flow. Through this scientists found that some activities produce more flow experience than others. Flow is more frequently experienced in work activities when one is trying to solve very challenging problems, and in hobbies and home activities such as cooking, sewing, photography, or singing. Sports were also very conducive to experiencing flow. What do these activities have in common? First, they require a focused and ordered state of consciousness. One has to be completely focused on the task and not allow any distractions to break up consciousness. Rock climbers are likely to experience this kind of focused attention. A rock climber must devote all attention to climbing and not be distracted by thinking of how high one is climbing or whether one will fall. Second, these activities involve an equal amount of skill and challenge. If a challenge is too great compared to one's skill, it causes worry, anxiety, and a breakup of consciousness. On the other hand, if the task is too easy, it is viewed as boring. How can trading be transformed into a flow experience? Make sure that you set up conditions to make trading fun and enjoyable. Trading certainly is a challenge, but some traders are overwhelmed, and this is not conducive to flow. The trick is finding a happy medium between trading strategies that challenge your skills but do not exceed them. If one tries to put on big trades or use strategies and methods that are beyond one's ability, for example, flow will not be experienced. When this happens, traders feel worry and anxiety. They cannot focus complete attention on monitoring their trades. So if you want to experience flow and perform at your highest potential, the key is to set appropriate goals. Manage your risk, develop a well-defined trading plan based on your current understanding of the markets, and do not make trading more complex than you can understand right here and right now. Do not trade beyond your abilities as you trade according to your current abilities and make small amounts of progress. You will experience trading as enjoyable. You'll be able to focus on trading the markets with a high level of focused attention, in the same state of mind that an athlete experiences when playing sports, a dancer feels while dancing, or an artist experiences while creating art. Soon your skills will develop even more and you can face even more challenging trading goals. With greater and greater experience, you will find trading more enjoyable, experience greater level of flows, and continue to hone your trading skills. Flow is an optimal state for traders, and it is worth learning how you can experience more flow while trading. Moving on to urges to follow. One of the most difficult things for a trader to learn is when to restrain his or her urges and when to give them free rein. The reason is that most of your urges come from gut feel and have little to do with the cold calculating and reasoning nature that forms the basis for most good trading decisions. But every once in a while you get an urge that you ought to follow because it represents the total sum of everything you have learned about trading successfully, and it offers an angle on obtaining a major gain that most other traders have not yet seen. Here are some guidelines to help you discriminate between urges to ignore and urges to follow. 1. If it makes sense, emotional urges tend to fly in the face of reason. They are like betting $1,000 on a single spin of a roulette wheel, where they certainly may come up winners, but chances are they will not. Yet other urges emerge from more rational mental processes that you may not even be aware of, but which are nevertheless valid. When you examine your urges in more detail, you find that some of them accurately take into account the tiniest details of what you know and conform to your deepest understanding of how the market operates. In short, with all your urges may contain a special kind of inferential leap. There are some that contain reasoning in which you cannot punch any holes. Secondly, if it follows your method, the bulk of emotional urges come out of left field and would be a major departure for you to act on. But a few of your urges actually fit within your trading method. These are worth considering because they offer the opportunity to tap into the different levels of knowledge and awareness without compromising the elements of trading, such as consistency and favorable conditions that are essential for success. If it is low risk, many emotional urges are of the damn the torpedo variety. If they turn out poorly, the penalty can be extremely high. These are the kind of urges you will do well to resist, but other urges fully incorporate your established risk management and money management strategies. But there's no extra downside if one of these urges turns out to be wrong. They may be worth testing. Moving on to changing your personality to suit your trading lifestyle. Many successful traders have entered trading after a successful career in another field. However, achieving success in the markets is quite different from achieving success in other occupations. The markets do not necessarily reward the personality traits that are developed and rewarded in other occupations. Do you have personality characteristics that have gotten you ahead in the world, but may not get you ahead in the markets? If you do, you may have to work on changing some of these traits to be a successful trader. Let us review some of the personality traits that may not be conducive to trading. Take conformity, for example. When working your way up the corporate ladder, it is vital to be able to perceive how you fit into the organization. One must accurately perceive what his or her superiors view as the direction for the company, regardless of whether one agrees with the direction or not. Conformity is often rewarded over thinking and independence. If you have worked in a corporate setting, you're probably aware of how everyone seems to dislike the person who is always questioning group decisions and seems to self-promote his own ideals at the expense of the group. In contrast, conformity is a limitation rather than an asset when it comes to trading. Ideally, traders look only within themselves for the ultimate answers. They do not rely on the opinion of others, are skeptical of prevailing opinions, and continuously try to find a new trading plan before everyone else so they can beat the crowd rather than follow them. Related to conformity is sociability. In many occupations, people work with other people. They must get along with others, perceive their needs, and sometimes yield to the needs of others at the expense of their own needs. Successful traders, in contrast, are rugged individualists. Many times, sociability and trading do not mix. A trader must make decisions, which again means looking within themselves to find the right answers. It may also mean spending a great deal of time alone studying the markets and preparing for trades rather than spending time with other people, which is also true of some other occupations. Traders might find the right balance between fulfilling the need for social contact and finding the time to spend time alone to focus on one's trading passion. Traders are creative people who take personal risks, think, and intensely focus on trading problems to develop innovative solutions. Creativity requires thinking, nonconformity, and social isolation. In many occupations, such traits are not viewed as desirable, so you may not have developed these traits. But if you trade full time, it is useful to develop some of these traits to some extent. The market as an unstructured entity. Because the market has no real time limits, perception of value changes constantly in the human mind. It remains to a major degree unstructured. That presents a challenge. We humans like structure. We like to take a certain action with the assurance that it will produce a certain result. We understand limits, borders, and finite situations. As most of us find out the hard way, the market does not work on that principle. Market volatility creates erratic moves based on emotion rather than logic, so the market changes its mind constantly. Constant change brings us on a mixed brew of possibilities, some rational and some that defy our sense of logic. How can we traders as humans who thrive on structure, order, and boundaries survive in a mercurial market? We survive by creating our own limits. We survive and thrive by bringing our personalized structure, meaning that our own definitions, rules, and criteria along with us. First, we gain all the knowledge we can and we add more every day. Next, we study our own psychological reactions to market movements and situations and strengthen our weak points. Then we can draw up a set of guidelines that structure each trade. These guidelines define our own personal structure, limits, and boundaries. Finally, we impose these onto the market. Now, are you in command of your actions? The game is being played by your rules, and that is what it is all about, is it not? The bottom line: should I buy or should I sell? Many traders often focus their own efforts on identifying buy and sell signals. The research and analysis they do are geared towards reaching the goal of getting to the bottom line, directive to guide their actions. Any successful, experienced trader will tell you that although properly identifying buy and sell signals is important, it is not the key to being successful. Instead, the way you manage each trade is what will determine your success. Traders who take the bottom line approach tend to believe that the success of their trading activity is dependent on following the right buy and sell signals at the right time. Clearly, it is important that a trader be able to understand the process of generating signals and to use the methods involved. Realistically, though, almost any trader can find a way to generate signals, whether using technical methods already out there or coming up with their own system or using their trading platform's automated signal generation tools. Any successful, experienced trader will tell you that your trade does not begin and end with a buy or sell. There's a trade management process involved. For each trade you make, you are making a group of decisions, and the way you manage and time those decisions is what will determine the success of your trade. Suppose two traders get the same trading signal at the same time and act on it.